Most people aren't losing money because they have bad stock picks. They're losing money because they're not making simple financial moves because no one ever taught them. But I'm going to show you what they are. And to let you know, they're not all that complicated. The very first one is not taking the employer match on your employer retirement account. It's so simple. This is essentially your employer saying, we want to give you additional money, and people simply don't take it. And they come up with all sorts of excuses why. I got too many bills, I got to pay off debt. It is essentially your employer giving you an increase in salary right away. Everybody always wants a salary increase. This is what they're doing. So to me, if you're not taking your employer match, you're essentially saying, I don't want this increase in my salary. I'm fine with where I'm at. Something to think about. The second mistake I see time and time again, because nobody told people not to, is investing too conservatively for where they're at in their lives. I see a lot of people in their 20s and 30s who are afraid of the stock market because they've heard all these horror stories about 2008 and things like that. But essentially what you're giving up is the additional compound growth for up to 40 years. That is a huge deal. They get caught up into the emotional part of investing. Huge mistake. Because being safe on your investments, if you're 20 or even 30 years out from retirement, can be one of the riskiest things you can do. The next one is backdoor Roth contributions. So what are these? Let's start out with IRAs, individual retirement accounts. There are traditional IRAs and Roth IRAs. Both of these accounts have income limits placed on them. I specifically see Roth IRAs a lot when people start making in excess of what the income limit is. They come to me and say, yeah, I can't contribute to a Roth IRA because I make too much money. That's not actually true. Shoot, I run into financial advisors that don't know this rule. Here's how it works. There is a small little loophole that allows you to contribute to what's referred to as a non-tax deductible IRA. And then all you do is you move that money immediately into a Roth IRA. It's the same thing as a Roth IRA contribution. It's just with one additional step. That's all you have to do. And it doesn't matter your income level. You can still do this. Now, there's one important caveat you need to know about this. It's called the pro rata rule. What this says is if you have a traditional IRA and it already has money into it, and then you contribute to it, and then you convert it over to a Roth, that gets to be a sticky situation. It's outside the scope of the video, but just understand there are tax implications to that one and possibility of doing it wrong and getting charged additional money. So if you already have money in traditional IRA, understand it can get a little sticky. But if you don't, the backdoor Roth contribution is an excellent way to still make your Roth contributions if you make above the income limit. The next two, I have a very simple story to illustrate the importance of. A few years ago, I was sitting on a beach with my family and a number of my friends' family. It was this beautiful day up in Charlevoix, Michigan. If you've ever been there, shout out to Charlevoix. A friend asked me, because he knows I'm in finance, he said, hey, what are some of the things people do every day that they shouldn't be? And I said, I'll give you two. The first one is they don't invest their HSA contributions, their health savings account. They put money into that account, but they don't realize they can invest it. The second thing they do is they keep their emergency fund money, all of it, at a local credit union. And it was hilarious because there was about 4 or 5 couples, and one by one, all the couples turned to each other at almost identical spots and said, and we really should start doing that. It illustrated my point perfectly. So let's start out with HSAs. HSAs are amazing. These are health savings accounts. You have to have a high deductible healthcare plan in order to qualify for these, but you can contribute money in there. And what most people do is they contribute the money and then they'll pay for their health expenses out of there. And essentially, you don't ever have to pay taxes on it, which is a great deal. But you can turbocharge your savings by investing it. I've only ever run into one HSA where you couldn't invest your money. All the other ones have an option to invest your money. So here's how it works. You contribute your money tax-free into the HSA. You then invest it, once again, tax-free, and it grows over time. And then eventually, you pull that money out for medical expenses. Once again, no tax. It's called triple tax savings. You never pay taxes on it. Put it simply, when people ask me what's the most powerful investment account out there, I say the HSA, which I think throws some people. Instead of keeping your money at the local credit union, which is going to, frankly, not give you a whole lot in interest, keep it in a high yield savings account, a money market account, something to that effect. The first thing I'll say about these types of accounts when you see high yield savings, money market mutual fund, they're essentially using the same types of investments. These are short-term, lower risk investments that they're using in these. And I would say the interest rates on those are comparable. There's going to be subtle differences. Right now, We're in the beginning of June 2026. I'm seeing those paying out about between 3.5, somewhere in there %. Just do some research. Take a look at who's paying out what. Yes, there is some additional complexity to holding it in these accounts because if you need the money, it can take you 1 to 2 business days. So what I would suggest is maybe keeping some money in your local credit union. We'll just say a couple grand, somewhere in that neighborhood, whatever is comfortable for you, but you can have that money available. But the rest of it, keep it in that high yield savings because over time, that additional few % that you're getting, it really adds up and it's going to help you out. The next move I would suggest against is keeping too much of your money in company stock. Here's how this works. People rise up into companies or a company offer these great incentive plans where they're giving you stock options or even employer stock purchase program. I was part of this when I was in the corporate world. It's a great benefit. Don't get me wrong. But what can happen over time is you've got people whose jobs are obviously with the company, so their paycheck depends on it. Their retirement funds are all with the company or in company stock. And on top of that, they had individual company stock in a separate account. There are horror stories about this. Enron and Lehman Brothers, 2 of the worst ones, where on the same day, people not only lost their jobs, but they lost their retirement accounts and their taxable accounts, all because all their money was in company stock. Here in Southern Michigan, I also remember 2008, a lot of people being employed at companies like GM and Ford, where once again, losing their jobs. And then when they leave, the stock dropped considerably, which is all their retirement accounts had in them. So they're just getting double and triple hit all at the same time. Try not to do that. Try to be diversified because if the company has a bad year, you don't want your life to end with your job. The next move I would suggest against is waiting for the right time to invest. I get this question a lot from folks. Come to me and say, hey, it's now a good time to invest in the stock market? I always find that to be an interesting question because if you look historically at the stock market, it essentially has always had an upward trend. So just using simple logic, now is always technically a good time to invest in the market. That's not saying that it's going to only go up. It could definitely go down. But based on historical data, essentially, it has always gone up till now. Now, before my compliance department jumps on me, I am not saying that for sure it's going to go up. But from a logical sense, it makes sense to invest in the stock market on a consistent basis because it's eventually going up. Here's the thing I would tell you. Nobody out there knows what the market's going to do. They just don't because we don't know what the future is. People try to act like they have all these little subtle indicators and things like that. They don't. The best long-term strategies we have always seen are all centered around consistency. So if you have to sit there and say, oh, I don't know, I feel like the market's going to go down and things like that, I suggest you watch my video on risk, which we'll link in the description below. The worst possible thing that you can do is miss out on some really good gaining days because you're sitting on the sidelines. And here are a few quick honorable mentions. These are great options to look into. I just didn't have time for them, to be honest with you. First one is Mega Backdoor Roth IRA. Sounds like this crazy amazing thing, and it really is. I would suggest if you're a high income earner, you look into that one. The next mistake I would say is not opening a taxable account after you have maxed out your retirement accounts. I see this one quite a bit too. People are maxing out both their employer retirement, Roth IRAs, which is great. But if you still have money to invest, a taxable account can be a great spot for it. And then the last one is not rebalancing on a consistent basis. Rebalancing is essentially buying and selling investments to go back to the allocations that you have in mind based on your strategy. When people don't do this for long periods of time, your allocations can get out of whack, and the data tells us that can have detrimental effects over the long term. As you can see, none of these are all that complicated. They don't require some advanced strategies or ensuring you know exactly how to pick the right stocks. All it takes is someone explaining it to you in a way that you understand so that you can institute it into your strategy. And that's what I'm here for. So thanks for watching.